All right, good evening, everybody. We'll go ahead and get started here tonight. My name is Thomas Wood. I'm the Director of Trading Operations here at Microquant, and tonight we're going to be talking about a couple different strategies for trading correlated markets. Now, if you have any questions throughout tonight, feel free to submit them at any time via the GoToWebinar side menu, and at the end and throughout the presentation, I'll try to answer as many as I can. The way that we have this set up is we're going to go through and talk about what are correlated markets, what are some different correlated markets, and then we're going to talk about 3 different strategies for using correlated markets to trade. After we do that, we'll pull up TradeStation and take a look at some real-time or live examples of a couple different markets, including one of the things that happened today that's actually a trade I took this morning. So we'll talk about that as well. Now, before we really get into things, I have to go over this risk disclaimer very quickly. Trading or investing carries a high level of risk and is not suitable for all persons. Before deciding to trade or invest, you should carefully consider your investment objectives, level of experience, and ability to tolerate risk. This content is subject to change at any time without notice and is provided for the sole purpose of education and assistance in making independent investment decisions. ValueCharts.com has taken reasonable measures to ensure the accuracy of the information contained herein. However, ValueCharts.com does not guarantee its accuracy and is not liable for any loss or damage which may result directly or indirectly from such content or from an inability to access such information or any delay in or failure of the transmission or the receipt of any instruction or notification in connection therewith. Any past performance results are shown for illustration and example only, are hypothetical, and as such have many inherent limitations. No representation is being made that any account will or is likely to achieve profits or losses similar to those shown. Past performance is not necessarily indicative of future results. And then along those same lines, we're required to show you the FTC Rule 4.41, just a quick hypothetical disclaimer, basically explaining that everything we're showing you obviously has happened in the past, and retrospect is 2020, hindsight's 2020, so it's much easier to say you could have done this and say it would have worked out fairly well because it's in the past. Now, first off, what are correlated markets? When we say a market is positively or negatively correlated, what exactly are we meaning? What do we mean by that? And it's 2 or more markets that usually move in very similar price patterns or in completely opposite price patterns. So they either both rise or fall at nearly the same time, or when one goes up, the other one goes down at the same time. Now, like I just said, there's both positively and negatively correlated. For example, some positively correlated markets are gold and silver, or JP Morgan and Bank of America, or crude oil, RBOB, and heating oil. They're all pretty positively correlated. Now, just because a market is correlated to another market doesn't mean that they have to move the exact same way, because they don't. It just means more often than not, they will. Now, there's also negatively correlated markets, and an example of that is euro and dollar. If you trade the futures markets, if you're on TradeStation, that would be at EC or at DX. Those are negatively correlated markets. And a lot of times, bonds and the indices will be negatively correlated. However, here over the past couple days, they've been moving together, both moving up, except for today. Now, a couple different strategies you can use for trading a correlated market. You can do what I call a double long or double short. So if you have a negatively correlated market, for example, the euro or the euro dollar, what you do is you go long or you go short in both markets at the same time. Okay, so if it's negatively correlated, that means you're expecting one price to go up and the other price to go down. The reason this strategy works is essentially you're looking to allow your winner to run and cut off the loser very quickly. If you're buying both of them and one's going to go up and one's going to go down, the loser, so the one that actually ends up going down, you get out of that trade very, very quickly, and then you allow the winner to continue to climb. And the goal of the strategy basically is to have your winner be more or make more than your loser. Now, this is just theoretically. I personally don't ever trade it this way because it's just not my style of trading. But I know a few different traders that do, trade like this, where they'll take longs in negatively correlated markets, or they'll take shorts in negatively correlated markets. And a lot of times it will work out as long as there's a big move. Now, the way you get in trouble is if the market fakes you out. So if you have a double long, so you're long in both markets, and this market jumps like this and then drops, or drops like this and then jumps, and you get stopped out right there, and this market runs, and you're stuck in the other one, and the other one did this and then drops, and you get stopped out on both of them. So that can be a problem, where you end up losing in both markets, even though one of them did end up eventually going higher. Because, like I said before, just because they're negatively or positively correlated doesn't mean they have to move the exact same all the time, or exact opposite all the time. Sometimes they will move together. Now, another way you can trade correlated or negatively correlated markets is you can use them to hedge your investment. So if you have a net long position in gold, for example, you could take a smaller position short in silver if you're afraid of a drawdown, that a drawdown is going to come. Now, the theory behind this strategy is that if you're incorrect on the overall direction, so you believe it's going to go up, you believe gold's going to go up, and then you take a short in silver to hedge yourself in case it goes down, because they're both typically positively correlated. If you're incorrect on the overall direction, your short in silver will make money even though your long in gold lost money. And this will somewhat limit your risk, because the gain from silver will make the loss from gold slightly lower, because it moves in the same direction. The problems that you run into when trying to hedge like this is if a market doesn't end up moving the same way. And another thing you have to be very careful of is, especially if you're trading gold and silver, for example, position sizing, because you may have 2 contracts long in gold, for example, and then you take 1 contract short in silver because you say, okay, I'm trading half the position. But the problem is a silver contract is essentially twice the size of gold. So you're really trading almost the exact same amount when it comes to how much that market will move. And the reason this can be a problem is you'll end up wiping out all of your gains on one side with the losses on the other side. So you come out essentially at even, which if you do that, you just lose commissions over and over and over again. The other problems you run into is, like I said before, markets aren't always positively or negatively correlated. Maybe one market will go very, very far, way down, and the other market will just come down this far. So you could lose a whole lot in your gold position and only make this much in your silver position, and what you thought you were going to hedge yourself with, you only end up making a very small amount of, or a fraction of what you had originally anticipated, and your losses end up being much larger. So that's another way you can take an opposite position in a correlated market, or you can take a smaller, if you have a net long position in the euro, you could take a smaller long position in the dollar. That way, if the dollar does end up going up, which means the euro does go down, you end up with a smaller loss due to the fact that you have a little bit of a gain in your dollar position, although you were anticipating that the euro would go up. The other disadvantages to doing this is it also works against you, because if you're right on the position, then you lose money on your hedge, so your gains aren't as large. So you may have a $10 move in gold, $10 an ounce move in gold, and silver moves several ticks against you because you went short silver to hedge yourself, and you end up with a net gain of 7 ticks in gold, or 7 points in gold, $7 an ounce. So you left $3 an ounce on the table. Basically, you gave that up for the hedge. So there's advantages and disadvantages to hedging this way with correlated markets. You can also do that with other markets. I'm just using gold and silver, for example, but you can do it with other markets. Soy, wheat, and corn, a lot of times they're correlated somewhat. You also have a lot of different stocks that are correlated with each other, such as your bank stocks, your tech stocks, things like that. You can also look at trading currency pairs that are correlated. So you have a Euro US dollar and a Euro Aussie. Now, they're not as correlated as other markets, but they both have the underlying pair of the euro, which makes it, or the underlying currency of the euro, which makes it correlated to the euro. So you can also do that in Forex. Now, the last strategy I'll talk about before we pull up TradeStation here is buying or selling with a lagging market. And this is one that I do use. The other two I don't typically hedge, and I don't typically take a double long or a double short. But what I do is I'll buy or sell the lagging market, whatever's kind of taking its time in moving when the other markets that it's correlated to have already taken off. And I'll show you an example of that happening today with the Dow, where the S&P and the NASDAQ and the Russell had already started to sell off. The Dow was a little bit behind, maybe a minute behind, and then eventually just turned around and shot lower, followed along with them. You can do this. What you want to do is you want to be aware of what markets are correlated, okay? So for example, the main futures correlations that I trade, soy, wheat, and corn, they're a lot of times correlated. Gold, silver, and platinum, they're correlated a lot, those three metals. Crude oil, RBOB, heating oil, they're correlated. 10-year bonds, 30-year bond, or 10-year note, 30-year bond, obviously correlated. Your indices, so your S&P, your NASDAQ, your Dow, and your DAX, and your Russell, they'll be correlated. And what you're trying to do is you're watching all these markets at once, and what happens is oftentimes 2 of the 3 or 3 of the 4 will start moving in one direction, and there'll be one that's kind of taking its time a little bit. It's hanging back. It hasn't moved when the other ones are. For example, today, NASDAQ was moving lower, and the S&P was moving lower, and the Dow was still sitting right up here, and these had already shot down by a bit. So it gave you the ability to jump in here, say, okay, the Dow's correlated to the other 2 markets. It should move lower with them. So what we'll do is we'll jump in, go ahead, take a short, and try to catch that move when this market follows along. And that's one of the things I did today in the market. A lot of times, for example, over the past couple of days, we saw, I should say not a couple of days, a couple of weeks, we saw crude oil really run after it broke out of a weekly pennant pattern. Well, after crude oil took off, it kind of stalled out for a couple of days. While it did that, heating oil and RBOB just continued to climb and climb and climb and climb in order to catch up with crude oil. Now, the reason markets are correlated a lot of times is because of fundamentals. Now, I don't trade off of fundamentals personally. That being said, I watch news announcements because you need to be aware of when a fundamental could come in and cause a major move, but I wouldn't trade purely off fundamentals. But if you think about it, crude oil is needed to make RBOB because RBOB is unleaded gasoline. Therefore, there's a fundamental connection between the two. Gold and silver and platinum, they're all precious metals, so there's a fundamental connection there. That sort of thing. So that's one way you can look to try to find where correlations are. The euro US dollar, or the euro futures contract and the dollar futures contract, they're negatively correlated because they're both based off of the euro US dollar, except one's on one side and one's on the other side. One's trading the dollar, one's trading the euro. So they typically will move exactly opposite. All right. Now, the theory behind buying and selling the lagging market, it's because since they're correlated, basically the majority rules. So the movers, the more that moved in one direction while the other one was lagging, they should be able to pull that market along with them. Now, I've seen it happen where one will just go do its own thing and the other 2 or 3 will do their own thing. And that's the risk you take with trying to trade this. It's even better, and here's another thing that you can do with correlated markets that I don't have up here, but it's even better when you're looking for a trade opportunity. And let's say you're looking to go short a specific market. Let's say we're trying to go short gold, or we're trying to go long gold. And you look at gold, and then you look at silver, and then you look at platinum, and all 3 of them show that, hey, this market should go higher. They all look very bullish based off of bullish divergence or off of a trend line. A lot of times what you'll find is silver and gold will both intersect trend lines almost at the exact same time. I've also seen it happen where silver will break a trend line and then 30 minutes later, gold will break a trend line, basically the exact same trend line, because they both move very similar. So you can kind of get a heads up for when that happens. That comes back to buying and selling lagging markets. But it's always good to be aware of what a correlated market is doing, because it can give you, one can act as a leading indicator, is basically what you're doing. So let's go ahead. Give me 1 second. I'll pull up TradeStation. We can take a look at some different correlated markets and some different trade opportunities that have occurred in those markets. So bear with me for 1 second while I pull up TradeStation. All right, and I'm back. Let's go ahead. Let's move back. It was around 9 o'clock this morning, right here where that red arrow is. You can see where the indices sold off a little bit. And this is the NASDAQ on the left, the S&P in the middle, and the Dow on the right. And we'll look at 955, where these markets were, okay? So you look, this is the bar that closed at 955. You can see this market was down quite a bit. This is the NASDAQ. NASDAQ had already taken a pretty significant move down. Then you take a look at your S&P. S&P 955, already taken a pretty significant move down as well. You broke all the previous lows here, where you had a little bit of support in both the NASDAQ and the S&P. Then you go take a look at your Dow, okay? The Dow was basically right up by the highs. Now this is the 955 bar where this red arrow is. All right, but if you look at the relationship between the highs and where the current price is when this bar closes, you're a little bit behind. You're a little bit closer to the top, and you can see here the Dow actually bounced right back up just about to the highs again, whereas NASDAQ, the very next bar, did nothing but go straight down. A very, very bearish bar, by the way. When you see that on a candlestick chart, your open is at the top and your close is at the bottom. That's very bearish. You had the same thing here. S&P tried to bounce a little bit, didn't get anywhere near where the highs, like the Dow did though. And this is where I got in the Dow with a short, because I had looked at NASDAQ was down, S&P was down, and the DAX was down. The DAX is one of my favorite markets to trade because of this lagging effect. You'll find the DAX lags behind the US market just a little bit, by a couple minutes, and you'll be able to see, okay, the S&P is dropping, the NASDAQ's dropping, the Dow's dropping. You look at the DAX, it hasn't quite moved yet, or one's going up, or three of them are going up, and the DAX hasn't quite gone anywhere yet. So you can trade the DAX as well. And we'll go take a look. Actually, I'll pull up the DAX over here where the Dow was. And again, we want to go to 955. So let's see, 930, 940, 945, 955. Again, DAX was in a bit of a consolidation today, okay? Right here, come across. And at 955, you saw the U.S. markets really move down. And I'll put an arrow over the DAX here in just a second at 955 as well. 935.45. 955. Okay. Right there is the DAX at 955. Now you can see the other markets, they already broke out of their support that they had been forming. You see the S&P here had bounced off the support level several times already. It had already broken through it and closed below it. NASDAQ, same thing. There was your support, or here was your support, depending on how you look at it. It had already broken through and closed below it. Then you pull up the DAX. The DAX was still staying above this trend line here, still in this consolidation period. Hadn't gotten out of it yet. It even gave you one more bounce to knock out the last couple stops and then took off. So you had almost 15 minutes worth of a warning before the DAX actually sold off to catch up with the other markets. Now the DAX is a huge, well, not huge, it's a pretty large contract though. So this move right here is a fairly decent sized move compared to markets like the Dow, where it's only $5 a tick. So watch for that as well. The DAX a lot of times will lag behind. Now let's take a look really quick. Let's go to a daily chart. Let me get rid of some of these, and we'll pull up RBOB, heating oil, and crude oil. All right, if you look at crude oil, you look at heating oil and RBOB, crude oil has been going up since the 24th. All right, you go back here and you see on the 24th, heating oil was still in this basing pattern right here. Heating oil didn't really break out until the 3rd, okay? You look at RBOB, you go all the way back 24th, RBOB, same thing. It was still in somewhat of a basing pattern here on the 23rd or on the 25th. It didn't break out. RBOB didn't break out until the 2nd. All right. Heating oil broke out on the 3rd. RBOB broke out on the 2nd. Crude oil broke out on the 24th, or started to move up on the 24th, and never really looked back after that. So you can see here, crude oil really started to climb, just up, 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 and you had about 2 to 3 days worth of a warning, trading days worth of a warning for watching RBOB and heating oil. And you'll find that this happens a lot also intraday. You'll have 5-10 minutes worth of a warning in these markets before it really starts to move. A lot of times you'll see heating oil will start to climb, or crude oil will start to climb, or RBOB will start to climb. 2 of the 3 will start to move one direction, and then the 3rd will follow. Now, there are exceptions to this as well, just like anything else. Here recently, we had crude oil was going up, and RBOB and heating oil not really doing so much. Or crude oil was going down, and RBOB and heating oil still climbing up quite a bit. So it's not 100% guaranteed, but if you pay attention, you'll find a lot of times the other ones will lead one market. The 2 will pull the 3rd. So that's really all I had for this presentation. I mean, I know it's not much. Pretty simple concept, pretty simple strategies for trading it. So if you have any questions, be happy to answer them. If you have any markets that you believe are correlated and you'd like my opinion on them, I'd be happy to let you know. If you have anything you'd like me to look at in the markets regarding correlation, be happy to take a look at them. But if not, then that's really all we had for today. Just a very simple, couple very simple strategies. Remember, once again, just to go over them, you have a double long or a double short. So you're taking a long position in 2 negatively correlated markets, or you're taking a short position in 2 negatively correlated markets, with the theory being that one market's going to run and one you're going to get stopped out on pretty quickly. Now, if you're trading this strategy, you have to make sure you let your winner run, because if you don't, then your loser is really going to negate the gains that you made on your winner. And again, the downfalls to the strategy, one, if the market doesn't really go anywhere, so if your winner doesn't move far enough to make up for the losses and get you in profitability, you have a problem there. If you get faked out where the market, you're double long and one market drops down, hits your stop, and then takes off and goes up, and the other one goes like this, then you lose on both of them. That's not good either. That's a downfall to the double long, double short strategy. The other one we talked about, hedging. If you're incorrect, or the way this works is basically if you have a net long position in a market, you take a smaller short position in a correlated market, so that if you're wrong, your losses are not as bad. So again, the theory behind this, if you're incorrect on the overall direction, your loss will be smaller due to the correlated position in the opposing direction. It can work. I know a lot of People that like preserving capital, they're not as aggressive of a trader. They'll hedge themselves by doing this, and nothing wrong with that. It's just another way of trading. Make sure you have a very correlated market, though. If you're doing that, you don't want a market that's slightly correlated. You want a very strong correlation between the two. Again, just to recap once more, buying or selling in a lagging market, this is where you're watching basically for the one that's lagging behind the others, and you're looking for a move to take place in 2 or 3 of the other markets that are correlated to it, and then you're watching for the one market that's kind of lagging behind, and you're jumping in on that one to catch the move there. For example, the Dow today lagged a little bit behind the S&P and the NASDAQ, and the DAX lagged behind the S&P, the NASDAQ, and the Dow. And then lastly, the one that we didn't cover or that didn't have on the slides is watch for a bullish or bearish signal, or buy or sell signal. So candlestick reversal in one direction, or trend lines, or a divergence in 2 correlated markets at the same time, or 3 correlated markets at the same time. That oftentimes is a very strong signal. When they all do the same thing, they all showing the same thing, it adds to the credibility of that signal. Again, that's all we had for today. For those of you that were a little bit late, this webinar is recorded. It'll be up on the Value Charts YouTube page in a day or two. Again, my name is Thomas Wood. If you have any questions, feel free to send an email into support@microquant.com. And that's all for today. I want to thank you guys for your time. Again, closing a little bit early, but really not that much to talk about with this strategy. Pretty simple, fairly easy strategies for trading correlated markets. So again, thank you for your time. Hope you enjoyed it, and have a great rest of the evening.